By way of an introduction, I am Hannah Van Ross and I'm a Senior Audit Manager at Shipleys LLP working in the London office. I have a diverse portfolio of clients working with owner-managed businesses to AIM-listed companies and groups. I also specialise in the financial services sector, working with a number of clients that are regulated and authorised by the Financial Conduct Authority. Currently, I'm also supporting a number of businesses move to cloud accounting for their day-to-day record keeping, particularly with Making Tax Digital now in effect, which we'll come on to later in the webinar.
Hi, I'm Rob. I'm a partner at Shipleys. We're a mid-tier accounting firm based in London, and I too have a diverse portfolio of clients. Hannah and I work with a number of law firms, which has allowed us to bring together common issues faced by firms, and today we're going to be running through some of the solutions available. We're also going to look at the future and the technology that's already out there, which firms are using to help them stay both compliant and to improve efficiency. Now, something else that came into effect in 2014 is the mixed member partnership rules. So what do we mean by mixed member? That means that some of the members are individuals and some of them are corporate entities. Now, a little while ago, having a company, a personal service company, was pretty common, and you may have been advised to set up a structure like the one you can see on your screen. Now, there's nothing particularly wrong with a PSC. A lot of people use them, and it's just a company by which somebody applies their trade. So why don't HMRC like this? Well, if you look at the diagram, you'll notice that that person on the left is both a direct member of the LLP, and they also have an investment in a company which itself is a member of the LLP. Now, when HMRC are looking at that company and working out whether you're caught by these rules, they use a term called power to enjoy profits. So they say if that person has the power to enjoy the profits of that company, then they are caught by these rules. Now, that's quite widely defined, but in general it just means if that individual can benefit economically from the profits that are allocated to that company, they are caught by these rules. So why don't HMRC like this? Well, if times are really good, what you can do is allocate some profits to the member and maybe much larger amounts to the personal service company. So remember, companies pay tax at 19%, but then it's down to the owner when they take that money out. So the dividends that you take out of that company and the tax you pay on them might be much later. Therefore, HMRC have a delay in the profits, in getting their taxes on the profits of the LLP. When times are less good, what the LLP could do is allocate a loss to the member and not to the personal service company. And losses are much more valuable to an individual than they are to a company, because individuals pay tax at a higher rate. So basically, this structure allows manipulation of the timing of tax. And if HMRC see it, what they may make you do is say all the income which you've paid to the company will be treated as income tax for the person, and that can mean a very big tax bill.
So is it okay if all the members are actually corporate?
Yes, HMRC actually don't mind this for two reasons. Firstly, if they're all corporate, you're not a mixed membership partnership anymore, because all of the entities are corporate. There's no individual members in there. And essentially, if you've got an LLP, because an LLP is tax transparent, that is, members are all companies, then essentially what you've just got there is a company for tax purposes. So HMRC don't mind that.
Where Making Tax Digital is going, and what the future holds for businesses and where taxes are going. So, as we know, only Making Tax Digital for VAT is currently in effect, but this is moving towards all taxes, and it's likely that Making Tax Digital for sole traders is going to come into effect next. This is not likely to be until around April 2021, though who knows, because as we know, VAT got delayed, so other taxes might be delayed also. So as we've sort of mentioned throughout, we know that companies pay corporation tax 9 months and a day after their accounting year ends, and LLPs and obviously individual members of those LLPs have to file a self-assessment tax return by the 31st of January following the tax year. Now, I touched on payments on account earlier, but just going a little bit more into those now. These are payments to account are essentially payments in advance to HMRC. Now they're payable in 2 instalments twice a year, so in the January along with the balancing payment for the previous tax year, and in July is your second instalment. Any balance is then required to be paid by the 31st of January following the 5th of April tax year end. Now the payments on account are worked out based on your previous tax liability and just split into 2 over those 2 instalments. Now HMRC see it as a way of spreading your tax across the year. It's more likely the case that HMRC just want to get their money out of you sooner. So that's sort of why they're introducing all these new making tax digitals to try and sort of, the way it's going is to recover money from businesses and get their liabilities paid a lot sooner. So I guess to help assess the likelihood of tax due is why accounting packages and people are moving onto these cloud-based softwares because it just allows clients that sort of easy access to look at their data at any point in time. It allows for timely record keeping, and therefore you can look at a snapshot of your business and roughly work out what your tax liabilities and your VAT liabilities might be due at any sort of one point in time. So I guess being on a cloud-based package just allows you to just get the access whilst you're on the go, and just allows that looking at it at any point in time, really.
So, Hannah, if I'm not currently on a cloud package,
Yep.
how can I move across?
Okay, so the actual transition is relatively straightforward. So if, for instance, you're on a desktop-based package, just take Sage Line 50, for instance. We've had numerous clients where we've helped them move their data from this sort of desktop version into the cloud. Now there is actually a software provider out there, and one we regularly use is called Move My Books. And essentially what they do is they move 2 years worth of historic data from your desktop version into the cloud for free. Now this imports all of your historic general ledger transactions, all of your customer lists, all your supplier lists, and it's just a very pain-free exercise because you don't actually have to do anything yourself. The software will move it all over for you. If you want to move more than 2 years, it's not a problem. I think they charge a small fee for doing so, and I'm sure there's other providers out there that do a similar thing. But we generally see that moving that 2 years worth of data is considered sort of a good amount for clients. There is other ways of moving the data across. If, for instance, you're on a spreadsheet, it's easy enough to sort of post opening balances into the cloud package that you move on to. But you can also import and export data. So there's certain spreadsheets that you can sort of import into, say, the likes of Xero for your customer list, your supplier lists, and you just have to tailor these into a sort of certain format to enable that import into the data. But generally, it does allow for quite a pain-free switch.